What if I told you that you only need 4 ETFs in your portfolio to reach true financial freedom?
Yeah, baby!
It is what you will discover in this video, where I'll share with you 4 of the best ETFs to have in your portfolio if you're looking for great capital appreciation and great dividend income. The first ETF that everyone should have in their portfolio is one that is tracking the most important market in the world, which is the US market. To do so, a great S&P 500 tracker would be optimal for you. It is why personally my preference is the famous Vanguard S&P 500 Index ETF with the ticker VFV. This cousin of the famous VOO is pretty much the same thing as its cousins, but in Canadian dollars. This Vanguard ETF has the objective to track the famous S&P 500 index, which is composed of the 500 largest American companies by market capitalization. A pretty interesting statistic about all of these companies is the fact that they have a median market cap of about $350 billion. And so you can understand that this gives you some exposure to some of the most influential and the most important companies in the entire world. It is why among the largest holdings of this fund, you can find well-known companies such as Microsoft, Nvidia, and Apple that all represent together more than 20% of the total assets of this fund. And so, with no surprise, the technology sector comes as the largest sector by far with over 32% of the total assets. Then we can notice other important sectors such as the financials and the healthcare that comes as the second and the third largest sectors. One of the big pros that you have by holding this ETF in your portfolio is the great potential of upside that it has in the long term. Indeed, 10 years ago, if you would have invested $10,000 in this ETF, it would now be worth over $45,000 or an average annualized return of about 15% per year. We can now understand why one of the most influential and successful investors of our generation, Warren Buffett, is recommending to most people to invest in a great S&P 500 index ETF.
1 million, 2 million, 3 million, yeah, right.
Add to this on your side, by holding this ETF in your portfolio, you could expect to pay some annual management fees of about 0.09% per year or $9 per $10,000 invest. Plus, on its side, Morningstar is ranking this fund as being as risky as the same types of fund of its category while having more potential of return. Furthermore, this ETF is distributing on a quarterly basis all the dividend income that they receive from the companies that they held in their fund with a distribution rate of about 1%. All of these factors makes that personally I really like this fund, and I believe that it is a great option for anyone that is looking for great potential long-term capital appreciation. And personally, it is an ETF in which I am trying to invest pretty much every single month to grow an interesting retirement account. Now that you found one of the best ETFs to track the overall American market, it might be a great option for you to add one ETF tracking their northern neighbor, which is the Canadian market. It is why, as my second option, I picked the iShare Canadian S&P TSX 60 Index ETF with the ticker XIU. As I just mentioned, this ETF is tracking the S&P TSX 60 index, which is a great overview of what is the Canadian stock market. And it has the particularity to be the first ever ETF created back in the 1990s. Now, when we dive deep down into this ETF, we can find that among its largest holdings, we find companies such as the largest Canadian banks, Enbridge, the Canadian Natural Resources, as well as the Canadian Pacific. It makes that the Canadian market that is often considered as safer compared to the US market has different sectors that are more important compared to them. We can notably find that the financial sector will come as the largest sector by far, followed by the energy sector and the industrial sector. The particularity of the companies found within these sectors is the fact that they tend to give and distribute more dividend income to their shareholders, as we can see with a 3% distribution yield on a quarterly basis. But this also comes with some lower historical annualized return that is of about 7.30% over the past 10 years. And so this would have transformed your initial $10,000 investment to about $24,000 nowadays. Nevertheless, compared to the same funds of its category, this ETF is still ranking as giving some great and more potential of return compared to them while keeping the same level of risk. Plus, on your side, by holding this ETF, you could expect to pay some annual annual management fees of about 0.18% per year or $18 per $10,000 invest. Overall, I believe that this ETF isn't only interesting from a geographical point of view, but also from the fact that it is giving some excellent dividend income for everyone that is looking for great passive income, for example, retiree. It is why I believe that it could become a great addition to your portfolio. Now for the third ETF on my list, I've gone with an international ETF that can be interesting for you to have other companies that are not on the North American soil. It is why I've picked the Vanguard FTSE Developed All Cap Except North America Index ETF with the ticker VIU. This ETF seeks to track the performance of companies of all sizes located in all the developed markets around the world except in Canada and in the United States. It is why among the 3,800 holdings of this fund, you can find great companies such as Novo Nordisk, ASML, Samsung, and Nestle among its biggest holdings. However, it is crucial for you to note that the ponderation of every single one of their holdings will be way lower compared to the two other ETFs that I just presented to you because of the number of holdings that they have, and so it will at the same time give them more diversification. Add to this, we can see that the vast majority of their holdings can be found either in Europe or in the Pacific, with countries such as Japan, the United Kingdom, France, and Switzerland that are the most represented. Also, it is important to note that we can find a certain overweight of about 70% of the total assets directly invest in all the large capitalization companies. Now, on your side, if you would decide to invest in this ETF, you could expect to pay some annual management fees of about 0.23% per year or $23 per $10,000 invest. Since the inception of this fund in 2015, if you would have invested $10,000 in that fund, you could expect to now have over $17,000 or an average annualized return of about 6% per year. So even if this fund isn't performing as greatly as the two other ones on my list, it is still ranking in the average for both the potential of return and the level of risk compared to the same type of funds of its category. But the beauty about this fund isn't only the fact that it gives you great geographical diversification with over 3,000 holdings, but it is also the fact that it is distributing a gigantic 5% distribution rate on a quarterly basis. However, at the end of the day, if you don't want to have the struggle to pick this ETF or this one, and if you want to basically have an all-in-one, in that case, one of the best options for you would be the iShares Core Equity ETF portfolio with the ticker XEQT. As I just mentioned, the objective of this fund is basically to track the entire market by holding thousands and thousands of different companies located in all the different important markets. A big particularity of this fund compared to their Vanguard competitor is the fact that they do hold directly other ETFs of the same company instead of holding different individual stocks in their ETF. It is why when we look at the asset ponderation of this ETF, instead of finding individual stocks, we find all the different ETFs that they are investing into. First, we can see that their largest holding by far, by holding about 45% of their assets, is an S&P US Total Market ETF. So basically an ETF that is tracking the entire US stock market. Then we have about 25% that is invested directly into the Canadian and into the developed market ETF. And finally, the 5% left is directly invested into their emerging markets ETF. It is why the largest portion of the total assets is directly invested in well-known companies that we know pretty well over here, for example, Apple, Microsoft, Nvidia, and RBC. On your side, to hold this fund in your portfolio, you could expect to pay some annual management fees of about 0.20% per year or $20 per $10,000 invest. Plus, if you would have invested $10,000 at its inception on the market in 2019, it would now be worth over $17,000 or an average annualized return of about 11% per year. On its side, Morningstar is ranking this fund as being in the average in terms of the total risk while giving more potential of return compared to the average funds of its category. Plus, the great thing about it is that it is also giving some great quarterly dividend distribution of about 3% per year. It makes that XEQT is definitely a perfect contender if you're looking for one single ETF in your overall portfolio. So there you have it. Those were 4 types of ETFs that are pretty interesting for you to have in your portfolio if you're looking for great and steady capital appreciation over time. As you can see, I've opted for an approach that is mainly based on a great geographical diversification to limit my overall risk in my portfolio. However, on your side, if you're looking for other types of approach and different other ETFs in which you could decide to invest for the long term, well, check out the video that's gonna be right over here, and I will see you soon. Peace.